Hello, and thank you for joining us for the latest eToro education webinar, the place to gain insights from the world's most successful investors. And I'm a freelance journalist, master of ceremonies, and host of the FinTech podcast. And for the next half hour or so, we're going to be taking stock of some of the opportunities and risks out there in big tech. Everything from volatile markets, valuations, to antitrust challenges. And who better to discuss than eToro Global Markets Strategist, Ben Laidler. Ben, great to see you again.
Thanks for having me, Elliot. Good to see you.
Now, Ben, as no one could have failed to have seen, tech performed somewhat strongly in 2020, but it's been a slightly patchier year so far in 2021. What's been going on, and how do you see the sector performing from here on in?
Right, so tech was obviously the standout performer of last year, and there was sort of two big drivers of that. One, we all used a lot more tech last year. We had this accelerated sort of tech adoption as we all worked from home, and we all learned how to use Zoom, and we all shopped sort of more online. And then the other thing that went on last year was interest rates and bond yields all fell, even further, and that disproportionately helps the valuations of the most expensive companies, which was basically tech. So that was the sort of 2020 story, or most of it. And then around the US election, so November last year, through to maybe end of March this year, investors rotated really strongly, sort of away from those tech names that had done well towards these sort of more cyclical stocks. So those stocks that were most exposed to the sort of reopening of the economies, the rollout of vaccines. So airlines, hotels, and broader segments like financials and commodities. And now, to your initial point, we're now in, what I see as a sort of third stage of sort of tech performance in the last couple of months, where that sort of rotation has completely flipped again, back into tech stocks. And what drove that is what the market's really concerned about right now, which is this sort of upsurge in new virus cases, the sort of Delta variant. People are, much more worried about sort of growth again, therefore much more worried about those sort of cyclical stocks and looking for, if you like, the safety in those tech stocks where the growth story is a little bit more secure. They're a bit bigger, and so really you've seen this rotation back into tech, and we're sort of back where we started a little bit.
Right, but of course, I mean, isn't there a chance that things become a bit more difficult from here on in as the kind of one-off boost from the pandemic and working from home begins to fade? Or are these changes permanent? Are these changes that we saw evolving over the last 12 to 18 months here to stay and likely to help continue to boost these tech stocks going forward?
Yeah, so I actually think these changes are sort of here to stay. I mean, last year we obviously saw sort of a big one-off acceleration of these growth rates. But I think even if you look sort of now, as we're reopening or into next year, I mean, those growth rates still remain very strong. I mean, this is very much a sort of structural story. Take the example of online retail, which, we obviously all used a lot more sort of last year. We saw this big acceleration. Online retail sales last year grew nearly 30%, globally, despite the fact we were in recession. 18% of all our retail sales last year were made, online. That was up sort of 4 percentage points relative to the year before. So, something that had maybe been increasing 1 to 2 points, a year, saw a big sort of 4 percentage point jump last year. So basically last year you saw sort of 2 to 3 years worth of growth all happening in 1 year. So that was nice, but it doesn't mean that you're going to see sort of no growth this year. I mean, you look at the same sort of online retail, it's probably still going to grow maybe 3 times faster than offline retail this year. So something like sort of 14, 15% online retail sales growth this year versus maybe only 5% offline. So yes, that's a lower growth rate, but it's still a multiple of what you're seeing offline. So that's just sort of one example. And the other one I would sort of give is look at someone like China, which I think in the sort of online retail world is sort of the future. Half of online retail sales in China, or half of retail sales in China, are made online. In somewhere like the US, that's 18 to 20%. So I think there's a very long way to go. You look at Alibaba Singles Day. I mean, they're doing 10 times. Alibaba Singles Day is 10 times the size of Amazon Prime Day, for example, in the US. So I mean, that just gives you, if you like, a sense as to ultimately where we're going to get to. And not to belabor this point, I mean, just to bring it back to sort of here and now, I mean, you look at the FANG, M stocks, so, the biggest tech stocks, so Facebook, Apple, Amazon, Netflix, Google, Microsoft, the biggest stocks in the world, these big sort of work from home, sort of lockdown winners. I mean, they grew earnings over 100% last quarter. Well through the lockdown, but they're still having these huge earnings growth. And those earnings expectations are continuing to rise. I mean, they're up another 15 to 20%, this year. So, my broader point is, yes, last year was sort of a real aberration of this accelerated growth, but that sort of structural trend of sort of outsized tech adoption, is going to keep running and running here.
I love how Netflix is part of the work from home kind of beneficiaries. Obviously, not everyone using their time working from home to work all the time. But on a more serious note, I mean, these companies, partly due to the growth that they saw in 2020 in their share prices, I mean, they're huge now. Is there a danger that they've just simply gotten too big? Should investors be concerned that their fastest growing days are behind them, and or perhaps that US markets are now just too dependent on them?
Yeah, I think that's an important question, right? I mean, these companies and the broader sector has just become massive. I mean, just to put some numbers on this, I mean, the so-called FANGs are 20%, just over 20% of the S&P 500 index. So that's a handful of stocks. And that broader tech sector, so if you include sort of information technology, communications, and things like consumer discretionary, which is where Amazon, that number is not 40%. That number goes over, not 20%, goes over 40%. And you can sort of take this further, right? Because so tech is 40% of the US, but US equities are nearly 60% of global equities. And what that means is, anything that sort of undermines sort of US equities, so tech gets undermined in the US. I mean, it really has sort of global ramifications. But I think this trend's going to keep continuing. I mean, and the example I give is just look at the sort of IPO activity, look at the amount of money that's flowing into private equity and venture capital, and that's disproportionately going into tech. And the IPOs we're seeing are disproportionately tech IPOs. So tech's getting bigger; it's not getting smaller. So I think I think that speaks to the tech adoption, and it speaks to the fact that I think we've just have to get used to this. A little bit. And final point here was the tech stocks we're looking at here and now, they're not standing still. They're getting bigger, right? I mean, AWS didn't exist basically a decade ago, and now it's just a huge part of Amazon, Instagram. I mean, you can go through these sort of giant new businesses that have all been built within the within the last decade or so that we sort of take for granted today, but really didn't exist a decade ago.
Right, and when we talk about the FANGs, or whatever acronym we're using these days for the biggest tech stocks, I mean, they are the biggest of the lot. How different are they from the rest of the tech sector, beyond perhaps the antitrust issues the very biggest of the bunch are now facing?
Yeah, so I think there's probably three or four really key differences. One is just the size, right? So you take the market cap of the FANG-Ms, and that's that's over $8 trillion of market cap. That's it's a quarter of the US equity market. Have they got that big? Or why do we put such big valuations on them? I mean, these are the other things that really stand out. I mean, their level of profitability, their level of operating margins are basically twice the average of the rest of the S&P 500. So they're hugely profitable. And secondly, they have these sort of fortress balance sheets. I mean, they don't have very much debt. They have huge financial flexibility. And that allows them to do a bunch of stuff that a lot of other companies can't do. I mean, they can basically go and buy anything they want. They can do a lot of mergers and acquisitions if they want. But it also means that they can return a lot of cash to shareholders. So, one of the latest trends is just, we've seen these big tech stocks just beginning to pay dividends and big dividends, and beginning to buy back an awful lot of shares. So one way or the other, whether it's dividends or share buybacks, they're returning a lot of cash. A lot of the sort of fruits of this profitability are going back to shareholders. And as you sort of touched on, this obviously comes with sort of its own issues, whether it's regulation or anti-monopoly concerns as well. So it hasn't been a sort of one-way street.
Right, and as you say, they may well be able to afford to buy whoever they want, but it doesn't necessarily mean they're going to be allowed to do so, because we've seen, for example, the regulatory noose apparently tightening around some of the biggest tech stocks. We've got investigations ongoing, although we know Facebook and Apple both won cases recently. how concerned should investors be? Or paradoxically, perhaps, would they actually benefit if there was some kind of trust-busting action and these massive tech stocks were broken up into their constituent parts? Perhaps that would release more value for investors.
So, it's certainly a concern, right? Everywhere you look, because of their size, because of their sort of ubiquity in our daily lives, they're definitely in the crosshairs of regulators globally. It's not just the US. We've got a G20 global minimum tax, which is basically specifically targeted at sort of big tech. Last week we saw President Biden come out with his sort of executive orders to try and rein in perceived monopoly practices. So, we could go on and on about the sort of different issues that are out there. But to your point, I think we've priced a lot in, and it's not clear to me that the outcomes are negative. And I would just say three very quick things. So one, these issues are hugely complex, and any sort of related case is going to be very, very lengthy. But it's very difficult to prove that these companies are actually harming us. The traditional anti-monopoly or competition yardsticks are, do I have to pay more for this? And most of these things are free. So, you're sort of in uncharted territory at sort of making the case. Secondly, I'm not sure the absolute worst case is bad for investors. So let's just, fast forward 10 years and everything else and assume we get the absolute worst case scenario and these companies all get sort of broken up. I can see investors sort of enthusiastically, adopting a separately listed AWS or a separately listed sort of Instagram, and that sort of breakup could actually crystallize a lot of shareholder value. I mean, people forget, the last time we saw this big sort of trust busting back in the sort of early 1900s, Standard Oil, used to be one big oil company, got broken up into 39. John D. Rockefeller, who was the owner of Standard Oil, was a multiple times richer after it was broken up than before. And then just my final point, not to sort of belabor this, is, I think investors know that this is out there, and you sort of see this in valuations. FANG valuations have basically moved sideways or down for the last couple of years. At the same time, that sort of broader tech valuations have just sort of continued to move up. And this, I think, is the market just sort of in its own way pricing in sort of these risks. So, again, I'm in the sort of camp that I think markets are being very rational here. They sort of price this in. I think reasonable worst case scenarios could actually be, in the fullness of time, could actually be good for big tech.
Right, and arguably Chinese regulators have been even more forceful, or Chinese authorities have been even more forceful in cracking down on their tech sector, especially notably on Ant Group and Didi. What's going on there, and are there implications for US investors?
It's certainly a different way of handling these issues. But I think, it's really important. The US, we've just talked, obviously it's a huge tech sector. The Chinese tech sector is proportionally even bigger. Alibaba was the biggest stock in China. It was the biggest stock in broader emerging markets. Didi, which IPO'd in the US a couple of weeks ago, was the second largest Chinese sort of IPO ever. So I think these issues are important. And the crackdown that you allude to that you've seen in the last sort of 6 months has basically made China the worst performing major equity market year to date. So the impacts have certainly been very real. What's driven it? I think it's on one level very similar concerns that you have in the US, right? I mean, the size, the control of data, the privacy issues. They've just been dealt with differently. I mean, they've been dealt with in this very accelerated manner, given the nature of the sort of Chinese state. But there are also some sort of broader issues at play. I think there's a political issue at play, an element of showing sort of who's in charge. There's an economic issue at play, supporting the sort of financial system. A lot of these big tech names getting into, financial services, and I think the regulator trying to catch up with that. And the third one is sort of the traditional sort of competition issues, the antitrust issues, which we've sort of talked about. But it's also, hasn't just been felt in China. I think we've also felt it, here in the US. I mean, the Didi IPO, didn't do well. US investors that invested in it, and broadly speaking, Chinese IPOs have been maybe 10 to 15% of all the IPO activity you've seen in the US, and that's obviously been somewhat harmed by the crackdown you've seen in China in the last 6 months.
Right. Well, we'll see. should be aware of?
Well, I guess a couple we've been talking about sort of recently. I mean, on the more traditional side, semiconductors, been very prominent. There's been a sort of global shortage as sort of tech demand has surged and semiconductor capacity hasn't. So we're seeing real shortages in some sectors, like autos, and that's created huge bottlenecks, impacted car pricing, car availability, et cetera, et cetera. And I think it's really shone a light on, the criticality of semiconductors to the sort of tech economy and the sort of narrative that semiconductors are sort of the new oil, right? That's the sort of criticality of semiconductors to the sort of new tech economy, and it's really benefited a lot of companies. I mean, it's been great to be an incumbent in the semiconductor industry. That industry is hugely consolidated around 5 or 6 really big companies in the last couple of decades. The sort of capital expenditure needs have surged. I mean, TSMC in Taiwan Semi, the biggest contract manufacturer of semiconductors, has $100 billion 3-year capex plan. I mean, the numbers are just astounding, and that reflects also how complicated this technology is, which is a huge sort of barrier to entry. I mean, sort of Warren Buffett type moat sort of around the sector. I mean, it's the sort of industry phrase is, it's not rocket science, it's more complicated. I mean, you put all that together, the sort of, the technology, the capex, the consolidation, it's good to be an incumbent, and it's very difficult, I think, for new entrants to come in. And the demand, as we sort of alluded to, just continues to accelerate. I mean, it was up nearly chip demand was up nearly 20% year over year in the first quarter. Full year, we're going to get close to sort of 15. I mean, these are very, very high growth rates. So that's a sort of traditional sector. I mean, one which may be less traditional, but it's been much in the news recently, is sort of space. Right. I mean, it's much smaller. It's maybe a 400 billion industry, but growing very, very quickly. We obviously saw Virgin Galactic go up last weekend. Blue Origin, I guess more recently. I mean, that's opening up a brand new market for space, which is the tourism market, and we already have, alongside that, the more traditional sort of rocket market, satellite communications, sort of data imagery, markets. I think what's really interesting about space is maybe less the sort of direct space sector itself, but all the spin-off technologies. I mean, it's absolutely remarkable when you sort of look around the world at all these different technologies, how many of them you can trace it back to, how many of them were developed in, in these various space programs, whether it's, CAT scans, camera phones, all the way through to sort of sneaker soles or, memory foam. I mean, it all came out of sort of space R&D programs. So to the extent that we're seeing, more space capex, more space R&D going in, I think you're going to see a lot more of these sort of spin-offs. It's a slightly tough sector to invest in. I mean, something like SpaceX, run by Elon Musk, is private, has a $70 billion private valuation on it. But, they put up 1,700 satellites to develop a satellite communication network sort of globally called Starlink, which will, probably come to the public markets sort of sooner rather than later. I mean, there's some ETFs out there, sort of ArcX by Cathie Wood. There's some defense and aerospace ETFs, sort of ITA. So there are sort of different ways in, but it's just the completely disproportionate impact these sort of new technologies that come out of space have on the rest of the world.
And you mentioned some of the ETFs. I mean, that's obviously one way to gain exposure to different tech sectors, but perhaps you can give us a sense of the best ways to gain exposure as investors to these either hot sectors or sectors that you feel are, going to be at the forefront of technological developments going forward.
So as in all these things, I think diversification is sort of super important, right? Don't put all your eggs in one basket. I mean, we have a number of copy portfolios sort of on the eToro site, which offer sort of diversified exposure to a lot of these themes. For FANGs, we have something called the Four Horsemen, which is Google, Microsoft, Amazon, and Apple, just giving you them all wrapped together. For big tech, that's the name of the portfolio. That gives you 25 of the world's largest sort of tech companies. The FANGs, Tesla, the big Chinese names, as well as some of the big semi names like Nvidia and some of the telcos, AT&T and Verizon. So sort of one-stop shop for big tech. There's a separate chip tech portfolio. I mean, the biggest sort of semiconductor names, the biggest 35 of those globally for people that just want to own sort of semis. And then there's a bunch of sort of more sort of broader tech-related themes. There's one called driverless, which is electric vehicles and autonomous vehicles. There's one called shopping carts, which is much more focused on e-commerce. So keep it diversified. Go for an ETF, go for a copy portfolio. To get sort of broader exposure to the theme.
Right, and we've talked a lot thus far about publicly traded tech companies. You just alluded to a bunch of them with some of those funds, but of course there's a whole army of multi-horned unicorns, if there is such a thing, and that's not a contradiction in term, like Stripe or Nubank or Revolut, and of course they're still private. Do you think big tech on public markets could look very different in a few years' time?
I think tech's going to look even bigger in a few years' time, and some of the names may well be different. I mean, you raise a very good point. So, those sort of unicorns, so, something that's got a public market valuation of over $1 billion. I mean, you've had 138 new unicorns just in the last quarter. And that's about 4 times what you would normally see on a sort of quarterly basis. And the driver of that is just sort of venture capital investment into the sector is just absolutely surging. So, autonomous vehicle companies like Waymo in the US, raised over $1 billion of private sector financing last quarter. In Europe, buy now, pay later, so Klarna. I mean, you just go through them. I mean, there's just a lot of them, and they're driving this IPO boom. We've seen IPOs in the last quarter up, maybe 200%, year over year. I mean, that's reversing this sort of shrinkage of US equity markets that we've seen over the last sort of decade or so. And I think that boom's just going to continue. If you like, that sort of private market financing is really telling us where the sort of IPOs and the new companies of tomorrow are coming from, and it's very much a sort of tech message. About 50% of venture capital financing goes into tech, and higher proportion than tech has in public markets today. So that tech weight, I think, is just going to keep is just going to keep going up. Some of these companies are going to be more successful than others. So absolutely, I think you're going to see a sort of natural, if you like, changing of the guard, or at least more big tech options, going forward than we've certainly got used to over the last 5-10 years.
Right. Well, I guess it's a case of watching this space and seeing how things look in a few years' time. So we'll look back and see if your predictions proved true. But look, we're out of time, unfortunately. So I just want to thank you, eToro Global Market Strategist Ben Laidler, for joining me again. Really great to chat to you as ever, and look forward to doing so again very soon.
Thanks very much.